This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I just saw this Ray Dalio article the other day, the head of Bridgewater, laying out his perspective for the new paradigm that's fast approaching. My guest today knows something about that new paradigm. He talks about it in his new book, How Money Became Dangerous, the inside story of our turbulent relationship with modern finance. The author of that book, Christopher Varelas, on my podcast today. We dive into all of the issues starting back in the 80s, bringing us up to current. What is modern finance today? What are the problems that we are facing? And what can we possibly do about it? Chris has had the chance to be at several prominent Wall Street banks, including Salomon Brothers. He is responsible for brokering some of the biggest mergers and acquisitions in finance in the last 30 years. I really enjoy these kinds of conversations, to get behind the scenes, to understand what's going on, to have the conversation, to have the debate. Because we all know deep down, negative interest rates, stock prices that go to the moon, someday we will all pay the piper. And these are the exact issues that Chris and I jump into today on our conversation. Without any further delay, let's jump right into my conversation with Christopher Varelas.
I loved your art of not thinking. I thought that was spot on. As a son of Greek immigrants, I loved your suggestion of wrestling naked. I thought that was just perfect.
You are right there in the headspace of interesting topics today. And I should say first from the very top, and you could tell me if I'm wrong, but it really seems like with your book, How Money Became Dangerous, you are right there influenced and inspired by many of the books that I read. Oh my gosh, 25 years ago, these would be The Predator's Ball, Barbarians at the Gate, Den of Thieves, Liar's Poker, When Genius Failed in the late 90s. I think all those books were right there in your headspace as you were going to town, weren't they?
I grew up with them as someone who loves history. And then, of course, you want to know the history of the world you're living in, an industry. You have to love that or to appreciate it. And the fact that Liar's Poker came out the day I got my full-time offer at Salomon Brothers is also part of it. I got the offer. I remember running down to the trading floor and I want to talk to the traders and they're all reading this book. And I'm like, I didn't even know you guys read. And then but no, this is a book about us. To see them reading a book and then to have this book, Liar's Poker, come out while I'm at Salomon Brothers also made me realize that there's so much great history and perspective in the world that I'm living.
What year would that have been?
That was the fall, I believe, of 89. I worked the summer, as you read in the book. I worked the summer and then I got a full-time offer. I was debating between them and Drexel Burnham Lambert. One of my claims to fame is I was the last person to ever get an offer from Drexel before they went out of business. Predator's Ball, of course, was the definitive book about their history and their place in the financial ecosystem.
I have to share with you just a really, really brief one, and you might have something that adds to it. In 1994, I was finishing up an MBA program. I was graduating from Florida State. There was literally nobody there with Wall Street connections, except one guy who was the then recently retired head of Salomon Brothers Europe, Jim Massey.
Jim Massey, I knew Jim, yeah, of course.
I did not know Jim, but I pestered him. He had just retired, so I took the train up from D.C., met him at a Greenwich office at the train station there, and then we walked over to a cafe, some French cafe. I didn't know him from Adam. I bothered him. I bugged him. He gave me the meeting time. He was just recently retired, one of the most influential guys in the street. I sat there and I rambled around and talked forever and he didn't say a damn word. It was like literally 45 minutes. And I just knew, here I am, a guy who wants to possibly work at Salomon Brothers. I'm like, this guy can make or break me. At the end of like 45 minutes, I'm like, God, I'm saying to myself, this is going downhill. This is not going to work. This is a waste of time. I just looked at him and I said, this is exactly what I said. I said, Mr. Massey, have I said anything today where you thought I was full of shit? Exactly what I said to him. He stopped eating his salad after 45 minutes, finally, and looked at me, raised his head and looked at me. He goes, yes, you said you wanted to be the best. You don't want to be the best. You just want to win. Now let's go talk.
That's awesome. That's Salomon. That's Salomon.
Great, right? I did not end up working there. I remember going for the interview and they wanted, like, did I have a PhD in physics kind of thing?
Yeah, about 94 was when they started actually caring about really focusing on your academic pedigree. When I started, they didn't care. The fact that I went to Wharton Business School, that was irrelevant.
It's funny when you say that's Salomon. What do you mean by that exactly?
Well, yeah, I always say I started at Salomon Brothers, worked on Wall Street 20 years, ended up very senior at Citigroup. I never changed firms, but the place I started working and the place I left were exactly opposite. So Salomon Brothers is probably the most Darwinistic firm in the history of corporate America, where it's all about merit. It didn't matter who you were, what you cared about, what your priorities were. You just had to be the best. There were rules. I mean, there were still rules. It wasn't complete free-for-all. And a couple of the rules I liked was you didn't stab people in the back because that showed you were weak. If you had to sneak around somebody, you obviously weren't the best. Or if you went after somebody that was too junior.
When you're saying the best, and I'm giving that story about him beating on me about the word best, you're using it in a different connotation.
Yeah, the best at making money. Sorry, yeah, absolutely. The best at making money. Not even the best. You don't need to be the best. Massey is dead right. You're right. It's can you make money or not? Whether you're the best, everything about you didn't matter. Could you make money? If you did that, great, you got ahead. If you did not, because back then I know it's hard to conceive of and to imagine, but it was the most meritocratic system it was. They didn't care who you were, what you were. You could be fat. There was actually very little. The jokes were crude, and were they racist and sexist? Yes, but at the core of it, it actually wasn't a racist or sexist place in the sense that if you were whatever and you did well, it didn't matter. Now, was it hard for those people to get jobs there? Of course, there was bias, but performance was blind there.
You raise an interesting point there, and just kind of a really side tangent. I think so many millennials today have been brought up with this idea that if one untoward word comes from your mouth, that must mean you're a demon. But the reality is back in the day, people would talk all kinds of you-know-what. It didn't mean they were a Nazi. It just meant they were just crude and rude, but it wasn't like people woke up after they talked like that and went and joined the Klan or something. We've reached a point where maybe, I mean, look, I'm not saying all this language is great, and nor are you, but I think you make the point.
Yeah, I mean, 50 things were said a day that would get you fired today. I think the interesting question is, can you get the benefits of disruption without disruptive behavior? That to me has always been the interesting question. As we sort of made Wall Street antiseptic and the whole financial services world antiseptic, and we've lost all these interesting personalities and we've lost these cultures, does that limit the creative aspect? And I would say there's lots of evidence that says that's possible.
I just saw a story the other day that said that when you're exercising, if you're dropping the F-bombs, it actually increases your ability to perform at a higher level. It's the adrenaline rush, it's the focus and all that kind of stuff. And they were specifically talking about the F-bomb. And I wonder if that goes right to what your point is that you're making.
Yeah, I'm going to have to change my workout. I'm going to try it.
Let's jump in big picture here, because you are laying out, and we're going to dive back in time a little bit, and I want you to do a little bit of historical education. I mean, I'm 51, so I did have a chance to read all these books. I find the story of Mike Milken just absolutely fascinating still to this day. We could start right there. I mean, you mentioned Predator. I mentioned Predator's Ball. You mentioned it. I'm going to let you run with it and let you explain. But gosh, if it wasn't for Mike Milken, how many businesses would not have been funded?
I think he's one of the most important people of the 20th century. And people, when I say that, their heads explode. They're like, how can you say that? He's a convicted felon for these various things. But the fact that he came up, there was a hole in the fence, meaning everyone in the spectrum could get credit from deadbeat consumer to AAA company. But then there was a segment there where if you were below investment grade corporate credit, you couldn't get access to leverage and to money. And he says, wait, that's crazy. If you just price it appropriately, it would actually be a win-win for the buy side and the sell side. And people would say, okay, wow, I get riskier credit but higher return. And then these companies are going, I get funded. So all of a sudden he's funding pretty much the TMT revolution that we're living with today. He's just one of these savants. I mean, he's just brilliant, the memory, and he's driven, getting up at 4 o'clock, reading the 4 a.m. with the miner's helmet so he can read on the train. It was obviously insufferable in so many ways, but a lot of these amazing disruptors are. And he created an entire market that funded the telecom industry and arguably the telecom industry that came from it. There's really interesting questions about when you're creating a market and you have to prime the pump. You do have to push boundaries in the fog of war. You're doing things. And I'm not going to defend the things that he was ultimately convicted for because he did push lines and go over the lines. But when you're creating things, you're in uncharted territories and you're probably going to do things that after the fact are going to seem suspect.
By the way, some names there that he would have helped fund, and I'm going from memory here, so you'll have to correct me if I'm wrong, but this would include the likes of Steve Wynn, Ted Turner, Boone Pickens, Teleco company MCI back in the day. I believe he probably even funded Trump on some of these casino ventures at some, when I say fund, I mean helping them to raise the assets. I mean, other big names that I'm missing there. I mean, there was a lot of names. It was everybody. It was the who's who.
Well, it was everybody. The names that come out are all the corporate raiders, Steinberg and Peltz and May. And because they were a new species and they were taking over these companies, I actually worked at Disney when Steinberg did the Green Mail and the Hostel of Disney. He was a bad guy. I mean, here I was this Disney employee and I'm like, who is this corporate raider coming in to take over the icon, the institution of America? Who is this guy? He must be a bad, scary person. But then as I learned in my arc when I went to Wharton Business School and then beyond, I'm like, no, this guy not only funded these businesses, but then recharged American business in general just by keeping management teams honest, because nothing kept them honest at that point. But now if they didn't perform, someone comes along funded by Michael Milken and says, hey, you're not performing. We're kicking you out. We're putting something in. You could actually make the argument that he was instrumental to the corporate success that we've had over the last 30 and all of the productivity and gains. Now, he's also at the core of the shift in which is being discussed by the Business Roundtable now and others and other people, the shift to the profit shareholder maximization model, because then managers couldn't just say, oh, I want to make the best product or provide the best service. I actually have to make money. That also caused that shift, which we're currently in the middle of debating whether that model has run its course or needs to evolve or needs to change. His influence is well beyond just that of even funding those businesses that we know of today.
Well, it's interesting. You go down the path of bringing up the phrase corporate raider. Some people will know what that means. Some people won't. Ultimately, it was somebody from the outside of a big company like Disney looking at a company like Disney and looking at their balance sheets and looking at their culture and saying, okay, maybe they've got like a monopoly, they got a cash cow, but there's no innovation here. They're just sitting on piles of cash. So it was these companies in America that maybe had gotten a little lazy, a little less innovative, still making a lot of money. And then these outside financiers just said, hey, hold on, let's put some heat to their feet and make them sweat a little. And you can trace that back to Milken.
Yeah. Now they're called shareholder activists. They have like a new positive name, right? So now what's amazing is the bad guys are now the good guys and the only watchdogs now on the public equity markets, because the rest of us are just these passive investors that don't want to pay fees. Now they're the conscious or the watchdog of the public equity markets.
By no means do I want to go back in time and try and defend the exact legal issues that Milken got ensnared in, but I did have a guest on this podcast. The name is escaping me at the moment. But he wrote a book called 3 Felonies a Day. And basically, if the United States federal government turns their eye onto you, that's me, you, whoever, they can find basically all of us committing 3 felonies a day. It's kind of funny sometimes, that word felony, it's like the code in Washington, D.C. that says we've done something wrong can be used to get somebody when they're in the sights of the management team that wants to get you.
Yeah, I've read the book. Look, Milken did some things that were clearly over the line. And just like they got Capone on tax evasion or whatever it was, at the end of the day, you set the target and you take what he got busted for parking stock, which in the scheme of things isn't the biggest, most major financial crime. It's a crime, but that's what happens. When you're in the system and they want you and you've clearly gone over the line, they're going to take what they can get. That's a whole separate debate.
Let me lay a scenario out for you and let you run with it wherever you might want to run. But I can remember in the mid-1990s, Netscape goes public, summer of 1995. The race is on. It's pets.com. Everybody's making a bloody fortune. I mean, Amazon went public, but Amazon wasn't a big deal back then. It was just selling books. Then we get the crash. We bottom out with the NASDAQ in the fall of 2002. We're down like 77% in the NASDAQ. 2003 comes along and things start to happen. We've brought those rates down to basically 1% at the time or so. And then all of a sudden, everybody starts buying real estate, as The Big Short shows. And then we get to the fall of 2008. And finally, we got to pay the piper, and things implode. We see things like San Diego, Miami, Arizona, real estate, condos, all these things just drop 90%. We get March of 2009. All of a sudden, as an observer on the outside, like someone flipped a switch. That flipping of that switch has now gone on until today. Basically, we don't have interest rates anymore, at least that you can earn passive income. But now we've got a situation where, to me, it looks like 2009 to 2019. It's like this black hole. I mean, how did we go from real estate in large portions of America being worth almost nothing, somewhat driven by trying to repair after the dot-com bubble, to get to the point now here 10 years later? It's very mysterious. And this is, I think, in many ways where you're trying to go with your book, which is, what is going on under the hood here? Where are we today? Because it just seems mysterious and befuddling to so many people.
Yeah, to save the system, we can argue the merits of it. We had to sort of make money free. We couldn't have the cost of leverage and the cost of the balance sheet take down the system. So we made money free, and that's driven interest rates down. If you have an idea, you can get it funded. If you want to finance something, you can get it funded, which has the positives of creating a lot of innovation, a lot of productivity gains, which is accelerating disruption, which is causing a lot of jobs to be displaced and a lot of old line businesses. That process is accelerated. But it's also, on the other side, created real burdens for people who need to fund future obligations. If you've written a check into the future, and we all know about the bubble in the room, which is the pension system, anytime you've written a check to the future, so if you're an endowment, a pension fund, anyone that needs to fund something in the future, you're getting no return on your cash or on your short-term fixed income investments. What do you have to do? You have to move down the risk curve. You have to take on more illiquid, riskier investments in order to get to the return you need to fund what you've underwritten. Quickly, pension funds are assuming a 7% return. So they're going to thinking, okay, all the money we have in our pension system, we're going to earn 7%. Experts, everyone knows that's unrealistic. It should be 5%. And these are general numbers. Don't take them as exact science. And so what they're doing is they're saying, you know what? We'll just invest more in riskier, long-term, illiquid investments to make up for the fact that we need to get to 7. So we'll earn 0 on our fixed income. $17 trillion of government debt has gone negative yield, and it's probably going to get higher. And so we can't make money there, so we'll just move along the curve. That's how I think you did a great summary of, we had this boom bust, we had this boom bust, we had that boom bust. The really interesting question is, what's the next one that's going to come? And we can see it. That's the interesting thing, is I don't feel like it's Cassandra or anyone's Cassandra saying, I'm the one person that can see it. We're all being complicit in this. We all know it's going on. It's not as though this is a secret.
Let me lay something out here. You brought up a word, pension, and you can beat me if I'm wrong, but I'm from the state of Virginia. The state of Virginia used to be a good old southern red state. The state of Virginia has become a battleground now for things, and the state of Virginia is very blue. I would argue it's not really about partisan politics that why the state of Virginia has become blue. The state of Virginia has become blue because of federal employees, and federal employees vote their pocketbook, and they just happen to vote for the party they think will align themselves best with their self-interest, which is preserving their economics due in the future, i.e. pensions. Now, here's where I want you to kind of really go to. You can correct me on that if you see different, but pensions don't really exist in America except if you're a government employee. We really have a situation where a relatively small number of people to the larger population are promised pensions just because they happen to be a government employee. And if you're not a government employee, these things don't exist. There is no such thing as a pension. So the entire country has to kind of bow down and figure out a way to pay government employees their promised pensions. Honestly, for doing work that is not terribly ambitious, not terribly innovative, and there's a lot of paper shuffling. That is a side tangent, and somebody can beat me over the head about that. But I did grow up in the Washington, D.C. area, and I've seen a lot of this. The Washington, D.C. area, working for the government is not Silicon Valley.
Yeah, there's so much there. There's so much there, but I'll stick to the challenge, which is there are private corporate pensions. And interestingly, they have ERISA. They have standards. You're actually not allowed to do certain things. You're not allowed to make these promises and underwrite things that you don't have funded. But on the government side, which is a question that I have, like, why don't these standards exist for the state, local, federal pensions? They don't. They're allowed to go where they will. And who's on these boards? Who's on these boards? They're the very same people. They're the union officials. They're the politicians. There's no one that's holding them accountable that has a time horizon consistent with the challenge. As I say in the book, if you're 60% funded, you might as well be 100% funded because you have enough to cover you through the term in office that you're overseeing the pension itself. And so I do agree. And then there's enough. You may say it's small. It's millions and millions of people. You don't need to get to that big of a voting block to make the difference. When everything comes out 50-50, the marginal group doesn't need to be that big in order to tip it. So I would actually say it's a very, very, very large group. That group will definitely, everyone votes their pocketbooks. There's no reason to pick on them. Everybody tends to do that. And so, of course, what are you going to be more worried about than your own pension? That topic is probably going to drive your decision making.
I think what we've all lost sight of is that perhaps 30, 40, 50 years ago, that if the government was looking to secure, whatever level government was looking to secure employees, they had to win them over from the private sector, which was booming. And so you had to make these promises to kind of seduce people. You're not going to make a high salary on an annual basis. You're going to get some back-end pension stuff. And nobody in the private sector really thought much of it. Okay, if you want to work for the government, you're going to get that deal. We get this deal over here in the private sector. Well, the private sector deals have kind of become Amazon warehouse stuff. And then on the flip side, the pension stuff has just continually gone up and up and up. I mean, look, if you happen to be SES in the federal government and you retire some kind of $150,000 salary or something, next thing you know, you're taking home, you retire at 52 or something crazy, you take home 85%. You literally get your salary for potentially the rest of your life, 40 years. You can get maybe 80% of your salary. It's certified nuts. I don't think the vast majority of Americans understand that. Government employees understand it.
Yeah, and I would add something more. When you're a mayor or you're some politician, you've faced a budget crisis. Oh, we don't have the cash to give a raise. Okay, we can't give them more cash. Let's just give them more benefits in the future when I don't have to deal with it. We're not only kicking the can down the road by not funding our current pension obligations, but the can is growing as we kick it because we're like, okay, let's just promise in the future to satisfy current cash shortages. And if you're going to give me a underwriting assumption that says I'm going to earn 7% on my dollar, it's actually not that expensive, but the math is wrong. There's many reasons why this continues, but the main reasons are there's no one accountable, and we become indifferent and completely, the rest of us, disconnected to government finance. Who pays attention to a funding bill that's on the ballot proposition or whatever form it is? No one understands it. No one looks at it. They read the one paragraph and they say, oh, this is going to fund something good. Sure, I'll say yes to that. But we don't understand how governments are funded. As I say, we don't understand the number over 80,000. We throw trillions and billions around. And the reason I pick 80,000, that's the biggest number you see and you know you're seeing it, which is people in a football stadium. Like, try to think of a time in your life where you see something and you know the number and you know that's the number you're looking at. And so we've gone into crazy numbers. We don't understand it. We don't care. We don't spend time on it. We're allowing a system, our antiquated system for financing government has completely not kept up with modern finance. It's just a structural mismatch at this point. The bubble, it's growing. If anyone tells you when or how or whatever, I think they're lying. But there's clearly a structural problem here that's growing, and it's due to lack of accountability and indifference on our part.
Pulling a headline from your world, and you're saying it right now, we got to work to return finance to its role of serving the people, or, these are your words, or our entire system may unravel. If I look at trying to understand, just if we talk about pensions for a second, trying to think about how governments unfold behind the scenes, every person on staff at any level has a vested self-interest in worrying only about their pension, about their sick leave that is just extra dollars as well too. All these types of things. When you say or the entire system may unravel, What does "or the entire system unravel" mean? Because I don't know what the entire system means. I don't know what unravel means from your perspective. I'm going to let you go there. But I tend to think that that's the only option. I don't know how the other option exists, because the other option is saying, how do we get finance back to serving the people? How do we get everybody aligned to understand that and then get them going in the right direction? So I tend to side on the unraveling part. What is the entire system? What is unraveling to you?
In the epilogue, I give you some visuals from some other places where it's happened. It's Occupy Wall Street. I went to Nicaragua 2 years ago. It was amazing. It's second poorest country in the Western Hemisphere, one of the safest. It was beautiful. I came back and I might as well have been at the head of the Chamber of Commerce for the country of Nicaragua because I was telling everyone to go there. April 15th, the president announces that there is going to have to be changes to the pension system because there's not enough money. We're going to basically run out in 3 years. 4 days later, the whole country descends into chaos, violence, killings. There's no way you're going there. That's an extreme unraveling. Then there's the Japan system, which is just the slow burn, no economic growth, no prosperity, very little hope for. It's still a lovely place to go, and I love going to Japan. It's lost its energy, its vibrancy. It's been described by some as the bug looking for the windshield. It's not. Unraveling is one extreme, but just lost. At some point, you have to pay the bills. And it might just be, I call it the last selfish grab of the baby boomers as we fund their retirement. It might just be the lost opportunity of an entire generation. That's not unraveling, but that's one scenario. I don't think you can tell. I think it's impossible to predict the tipping point. Just like every bubble that burst after the fact, you're like, okay, well, you learn a new act. I worked on the Orange County bankruptcy. It's like no one knew what a derivative was before the bankruptcy. Nobody knew what a collateralized mortgage obligation was before the housing crisis. We're going to learn some new 3-letter acronym and some new instrument that we've never heard of before. And it's going to happen in ways that no one can predict.
Ray Dalio had an article come out just literally the other day talking about a lot of the issues that we're talking about. The money doesn't cost anything if you're creditworthy. Now we've had the big rise in asset prices. Companies don't have to make profits anymore. And investors are essentially driving the VCs and funds saying, you must take our money and you must do something with it, even when the investors and VCs know there's really nothing to do with it. It's kind of, I guess that's an example of, as you say, look, if there's no interest income, we got to deploy the money somewhere. It almost seems panicky that you have investment funds out there saying, hey, take our money and do something with it, or we're going to take it and give it to your competitor, or we're going to make you hurt in some way. And the VCs are like, okay, we'll take the fees. We'll do something with it. We'll try to do something with it. It's terribly nutty. As Dalio says, look, there's some kind of paradigm shift is going to happen, but he also does not attempt to say any kind of date.
It's hard. I think you lose credibility if you think you can say this could go on for quite a long period of time. And the Bridgewater folks are some of the smartest people on the planet, extremely impressive and thoughtful organization. But the basics there are true, which is when money is free, you're going to seek the return somewhere, and the supply of money is going to go there, where you start to wonder, okay, that has to. I feel more and more that people say, I'd rather have you invest billions and get me 15% than invest hundreds of millions and get me 30%. As long as it's more than 7, which is, I'm picking 7 because that tends to be the underwriting target for most of these pension funds. As long as it's more than 7, I'm okay. And if there's a lot of people going in that direction, it's going to create unhealthy supply and demand. And we're seeing that with WeWork having to correct all of these IPOs not performing, the private markets being level set. Still, if you had said, 3 years ago that WeWork was going to be worth 10 billion, or 5 years ago, you'd be like, wow, that's great. The problem is it was 70 and now it's whatever it was and now it's 10. It feels awful. But hope and reality never trade together. Hope is either way out in front of reality or it's short of corrects and it's all about cash flow. So these corrections are expected because nothing moves up and to the right in a steady path.
Let me keep you at WeWork for a second. I had to go back and do some homework because I've not followed this thing. I mean, I know young entrepreneurs have been working at a coffee shop, so I guess in the back of my mind, I saw that there was some magician that was saying that he was going to take all the young kids working on their laptops in coffee shops and put them in the most expensive real estate in the world, and that we would have a successful model. Now, I had to do a little bit more digging because I had not really followed this, and I see that this prominent Japanese investor named Masa, who at one time in the dot-com bubble was the richest guy in the world for a brief moment. Then he lost 99% of his net worth. Then he went ahead and made a fantastic bet in the early 2000s. He put $20 million into Jack Ma and turned it into $150 billion. Probably the best bet ever. Clearly, from a statistical standpoint, there's a lot of luck involved there that Masa was able to make that bet. I don't take anything away from him. He was able to make that bet. Now he's got all that capital. He can do what he wants with it. Then he starts to raise funds. He goes to Saudi Arabia, he goes to the Middle East. He raised all kinds of money from guys that just happen to be sitting on oil, just money spewing out of the ground. He goes ahead and he says, let's create this fund and let's invest in these companies. And he puts, I don't know what it was, 5 to 10% of this one large fund into WeWork. From a VC standpoint, I'm like, okay, if it didn't work, it didn't work. That's the way things work. You take experiments and try. I think the interesting thing about WeWork, though, is that they got so close to the IPO for then the banks and Wall Street, still attached to some semblance of reality, looked at the financials and said, this is phony baloney. So I think in a way, I don't blame Masa and his people at SoftBank for trying to take a VC bet on a flyer. But then if that thing would have gone public, we're at a real ruse. That would have been a really, you almost wonder if that could have been some kind of a tipping point if it actually would have gone public.
Yeah, I mean, for the record, I'm a believer in the industry. I'm an investor. We're invested in that industry. There's a place for it. So it's really a function of what are you selling and for what value and to whom. What's interesting is Uber probably would have gone public at a much lower valuation, let's say 10 billion, 5 to 10 billion. And then the public would have gotten the benefit at least to 60 rather than going public at 60, then dropping from there. So there's a lot of different dimensions here. The interesting thing I think about SoftBank is when you have so much money to put to work, it's only natural that you'd have these extremely large vehicles to efficiently do that. So it's not surprising that an entity like SoftBank exists. The question is, okay, when and how are they accessing those public markets and for what reason? There's this great phrase out here now in Silicon Valley that's going around. I don't know if you've heard it, yoga babble, which is defined as if it sounds like your mission statements written by a yoga instructor, then you should probably stay away from that company. What are you selling? How are you selling it? Who are you selling it to? These are the real interesting questions in this modern. Once again, we have a system that is it evolving given the changing incentives that investors and people that need money have in the modern world of finance.
I've not heard the yoga babble thing. I actually participate in yoga. I can still do the full splits, so I'm pretty good at it. When you say yoga babble, I was just laughing because I wonder though too, I just happened to see a PowerPoint presentation that I think, I didn't get a chance to verify, but came from SoftBank. And it was very much in the headspace of what you just described. It was like love and all these kinds of amorphous, non-tangible, non-financial drivers. And I thought to myself, well, is this real? But then I thought to myself, well, gosh, are we also potentially bumping up against East meets West? Is the Western American side saying, oh my God, that sounds too something, but maybe from a Zen mindset or a Buddhist mindset, it makes more sense? Or do you just side to the yoga babble side?
Well, no, I think this goes back to the business roundtable discussion. Should it just be about shareholder maximization? Shouldn't it be about community and labor and all of that, which is consistent with sort of that Eastern Zen balance, taking into account all the parts? So I think the desire by some, many, whatever the right word is, to sort of think beyond the model of shareholder maximization, which I think is being inappropriately defined. I don't think the debate, I'm happy to talk about, I don't think the debate is actually the right debate at the moment. We're seeing the push to want to be more consistent with that Eastern balance, thinking beyond shareholder model.
Let me take you back to something that we spoke about earlier in the conversation. And this is the lack of interest income. And this is just to go really big picture. I can think of my grandmother's situation. She passed away at about age 100 a few years ago. When I first saw, when my grandfather kind of stroked out in the 90s and I saw her portfolio situation, I thought, wow, my grandfather had done a really nice job at setting up his wife for the foreseeable future. And then she lived for almost 20 years longer. But with healthcare costs and no interest income, all of his work for those decades to put her in a position to have to perhaps make 5 or 6, 7% through a combination in money market and, let's say, tax-free munis did not come to pass, because basically it all disappeared right in the time that after he passed, she needed health care for the next 20 years. And then by the time she passed on, she did not leave much, even though one would have looked at what she had in the 90s and said, oh my gosh, that's a home run. My grandfather did great. Now this has to be playing out across America in just millions and millions of families where instead of being able to have the ability to live on that interest income, it's just gone. So the real question becomes, I think you'll probably agree with that, but what do people do? What do the individuals do? We've talked about what pension funds do, what they do to reach. What does the individual do that just realizes, man, I'm going to have to spend down my principal?
Yeah, or they're saying, I'm not saying this is bad advice, but they're saying I need to move down the risk curve, which is I need to be more allocated to equities, which doesn't provide that consistent, reliable, predictable interest income. Or they can buy an annuity, which has got all of those challenges around it, good and bad. But you're moving into equity and you're seeing more and more saying, you know what, I'll buy equities. I'll buy them very cheaply. I'll use these passive ETFs where I don't need to pay a fee, so I don't have to worry about that eating into my returns. And now we're seeing a massive inflow. I think well over 50% of all equities are owned through passive ETFs now. So the people don't really know what they own and they're not really involved, but they're like, okay, I went from very low equities to something higher. And so hopefully that'll make up for the fact that I'm not. But that's a balance sheet that has a couple of issues, of course. That's a balance sheet thing that they're hoping to grow that then they can spend. It's not an income benefit. As you get older, of course, you should be shifting from, all things equal, you should be shifting from equities to fixed income. It creates all kinds of bubbles, create bubbles, make other bubbles. And now there's a lot of bubbles sort of coming together that we don't know how they're going to interact and what the cocktail we're creating is where it's going to take us.
What's interesting too is that you're saying, and this is the message that the individuals are getting, is like, okay, you've got to do the same thing as the pension funds. You've got to go into stocks. You've got to, or at least a much higher percentage into stocks. At the same time, where they can read the headlines that the guy that was the famed investor in The Big Short, Michael Burry, is telling everybody that passive ETFs are a bubble waiting to happen. And Ray Dalio, one of the richest guys in the world, is saying the entire thing is waiting for a new paradigm. So while you have no ability to get interest income, and while, quote, Wall Street is telling you to go get this stock market return, some of the brightest guys on the planet who have made bloody fortunes are then saying, don't do it, or they're essentially saying don't do it by telling you that that's a bubble. For the average person, they've got to be pulling their hair out.
Who really, and this is what drove me to write the book, do we control the financial system or does the financial system control us? Who really is thinking holistically about the big picture? And you can tell me the Fed has a role, and of course they see part of it, but it's still not the full aspect. As each party sort of pushes its self-interest within its corner of the financial world, we're all acting rationally. That's the thing about it. It doesn't mean the system, if every party acts rationally, it doesn't mean that the system will create these incentives and pressures and the like. Where does it all go? And so the question to me is, what can we control? What are we really doing about it? What decisions are we making? What are we complicit in every day to facilitate these bubbles? Because we do it, and what can be done? And my book is an attempt, and I'm sorry to go back to the book, but my book is an attempt to say to someone, you don't need to know anything about finance. It was written for someone assuming zero, even though Wall Street people I found really love the book too, is I want to explain to you the tensions or the losses that have happened in the financial world that are creating the risk that you face. And hopefully by understanding it, you can craft a path forward.
Before I let you go, I want to dig a little bit on personal experience. You mentioned, we brought up Mike Milken. You shared some nice thoughts about why he was important to the financial industry. I brought up somebody like Jim Massey. You obviously knew him. Are there any people that you might like to share, individuals that you've had, whatever interesting experience you want to describe? But are there a few, 1, 2 people along the way that you've had a chance to be really close to that you just walked away from, either through their actions, their innovation, that you just walked away from that close firsthand experience of saying, wow, that was one impressive individual?
I was just with him the other night, one of my first bosses at Salomon, and he was a real headbanger. You feared him. You weren't going to leave a meeting with him. You were going to be bloodied. It was just, you had to go in with shields up and ready to take it. But he told me something that I think is so powerful, which is he would ask me, like, why is this presentation going to be interesting to the other person? Why is the CEO going to care about this book? He's probably going to see 10 like it. Why is ours going to stand out? And by the way, don't come back until you have something in this freaking book that is going to make a difference. And the story that I recount from him, Eduardo Mestre, in chapter 4 is we created this great book. The book didn't show up, and it was he and I looking at each other because the rest of the team was stuck. This is before modern technology could solve this problem. We had nothing, and I pointed a fortune cookie to him that I saw, which I liked what it said, and I said it's sort of indicative of the situation we're facing. He's like, all right, we're going in with that. So we go in with a blown up fortune cookie into the boardroom or into the senior management of Northrop and convince them to go hostile on Grumman with a fortune cookie, because he was able to give the advice that was differentiated and made a difference and got to the core of it. Northrop Grumman, which is now one of the most important companies in the aerospace business, if not in corporate America, you could argue wouldn't have happened possibly without him realizing, getting to the core of what advice is different and what matters, using the vehicle of a fortune cookie to get it across. And that's what I mean. So I think...
Can you share in a summary what was so important about his advice? What was it at that moment in time?
Well, it was one of those situations where Northrop was sort of this middling player. So what happened was the wall fell, and there was this famous Last Supper where the Secretary of State and the head of all the government officials in Washington at the time in the early 90s was saying, like, look, you guys have to consolidate. The spending levels are going to drop dramatically, and we don't need 50 aerospace companies. So you guys got to start teaming up. And so the question is, are you going to be a consolidator or consolidatee? The argument was the best thing for us to do, given our situation, is to consolidate and to pick the right company on the chessboard and maneuver. The shareholders either would have gotten $30 or whatever it was by selling, or many, many multiples of what they ended up getting because they ended up being a force in the industry. And I think that one's unambiguously created real value for not only shareholders, but also a great company by choosing the route they did. What's really interesting about this, and hopefully captured the story in the book, is for an industry that made weapons whose purpose was to kill other people, the industry itself was a very gentleman-run, very sort of proper business. Interestingly, doing a hostile in the aerospace industry was considered very out of character and unacceptable. Now, this was a time when hostiles weren't happening. There was a big lull post the bust of the leveraged buyouts in the 80s. This was a big and shocking move at the time when it was done. But I think that's a lesson for all of us. And I think it's consistent with your last podcast, which was great, which is what facts are you taking in? How are you analyzing them? What decisions are you making? It's one thing to be susceptible to false information, but then the other question is, what's the opportunity in realizing that others are going down a path based on facts that may not be accurate? And how is your presentation when you walk? And now I think about it, every meeting I do, every meeting I walk into, whether it's a person, an institution, whomever it may be, I go in with Eduardo's words in my head, which are, how is this going to be a good meeting for that person? And if it's a good meeting for that person, then I probably have made a connection that will benefit all of us in the long run. And I think it's been, to the extent that I've had success, I think it's been a key part of that success with that mentality.
You've got an interesting work here because it does, as I mentioned at the beginning, kind of right there in the headspace of some of the classic narratives that were put out in the 80s that really explain things in a plain way, in a fun way, an interesting way. But you also, and you could see this right in your title, How Money Became Dangerous, it opens up Pandora's box for somebody like me, and I'm just a proxy for everybody, to kind of go off on tangents and be a little impassioned about these issues, because I don't know how you feel about some of the tangents I went on today, but I feel like they all kind of spring from where you're writing from. It's like, hey, this stuff is all real. We're all dealing with it. And how do we feel about it? What are we going to do? Can we do something? Is there even a we anymore?
Well, I don't think they're tangents. I think they're the issues. I think the whole purpose of the book or any of these conversations is to provoke and to say, okay, this is the core tension in finance. And then you look at that tension and you realize what makes it so hard is there's good and bad to everything. The line on Wall Street is every bad idea started as a good idea. So it's not as easy to just say, oh, that's bad, let's just get rid of it. No, you can't get rid of it because either we've gotten to the point where you can't go back in time or you don't want to lose the good that comes with it. And that just provokes all kinds of interesting questions and realizing that, okay, this domino is going to make that domino fall and so on. And I don't think they're tangents. I think they're what comes out of a provocative debate.
I brought up WeWork and I brought up SoftBank and Masa. Having to go back through that to kind of realize how he got started, this Japanese investor, making a couple $1,000,000 while he was in his dorm room in California, launching SoftBank, becoming, quote, the richest guy in the world for a brief period of time, losing it all, almost all of it, and then to turn around and put $20 million into Jack Ma and turn that into $150 billion. That is the classic American success story. That is it. That's beautiful. That's a wonderful story. There's all these other things going on too. I think we would probably be okay if it was more the mentality of a guy like Masa who lost 99% and then dug himself out of a hole, or even a guy like Sheldon Adelson, who basically lost 99% on Sands during the 2008 crisis and dug himself out of a hole. That kind of risk-taking is, at least for me, is much nicer to observe the risk and reward than perhaps this government stuff with the pensions and all the crazy stuff. And look, you have met these guys, and correct me if I'm wrong. The typical person that's involved, the typical government employee that's involved with managing these pension assets, I don't want to say how many four-letter words I can say about them. They're not impressive individuals overall. If you can't comment because you have to deal with them, that's understandable. But I'm just saying they're not the most impressive people.
I will say this. There are some very impressive people. I know them. I guarantee you I could introduce you to some very impressive people.
Are we on the edge of the bell curve with the outliers, or are we saying that?
No. And by the way, I would say the people that do this in Canada are super impressive on any scale. And there's no bell curve. The people I've dealt with that are dealing with this issue in Canada, super impressive. The regulators in Singapore, super impressive.
They're already on my Amazon page right now writing 1-star reviews for my book.
Okay, well, but let's stick with the U.S. This is the part that should scare you. Are they attracting the best and the brightest? And is there political pressures? Yeah, those are all questions. But when I talk to someone who is impressive, who does know what they're doing, and they tell me, quote, unquote, this is a direct quote, I have to spend more of my time on the politics than I do actually figuring out how to best invest the money. That's where the system falls and is broken and needs to be fixed.
Okay, but if that person is saying that and they kind of know the right way, but they can't do the right way, but they exist in the wrong way to collect the fee and collect the salary,
No. They're fighting the fight. They're doing everything they can. So they're saying to do the right thing, I have to spend so many hours moving this group to the right place. With the difference between Salomon and what became Citi, I always would say, Salomon, you had to spend 80% of your time winning the business because it was so competitive and you were Salomon, but only 20% actually convincing the organization what to do. Citi, you had to spend 20% winning the business because you were Citi and everybody sort of had to work with you, but 80% of the time convincing the organization what the right thing to do. I mean, it's sort of, where is your battle? If you have the benefit of scale and scope, you can win business, but then moving that battleship is painful. That's where the system, I think, is flawed, which is it's too laden with agendas that go beyond the core mission, which is how do we most effectively satisfy the obligations that we've underwritten in the future and not have it be clouded by agendas that get in the way of that mission.
So many of those obligations, and I think you mentioned that there are some corporate pensions, but primarily these are public pensions. And I think there's a real potential battle line there, because ultimately you're going to have government employees versus Americans who are not government employees. I don't think that that's properly understood yet by the Americans that don't have pensions. I don't think the average American that is not a government worker understands the benefits and the guarantees that have been promised to government workers with no funding to pull those promises off, which ultimately, for example, in Dalio's recent article, Dalio said you're just going to have to raise taxes. Ultimately, are we talking about raising taxes on Americans that are not government employees, that don't have the pensions, to help give the pensions to government employees? It's messy, and that's going to be a battle. You raise all these issues. I mean, it's great stuff.
I really enjoyed the conversation. Thank you for the opportunity to have this debate. I think it's the most important conversation we're not having. We're all complicit. All these other issues on sustainability, and look, I'm not saying they're not important, but we're having those conversations. This one is not one we're having. There's going to come a day where we're going to have to make these very difficult decisions, and it's going to be much worse because we didn't address it now.
How money became dangerous, the inside story of our turbulent relationship with modern finance. Again, a lot of topical issues as we have laid out, but also that interesting backstory and your personal experiences, a lot of detail, entertaining, great stuff. Chris, I appreciate you coming on today. Is there a website? Where would you like to direct people? Amazon for the book and all that kind of fun stuff, but is there any place you want to direct people?
There's a How Money Became Dangerous website where you can read the reviews, order up a book if this is interesting enough. That's the easiest, or Amazon, of course, or we're published by Echo, which independent bookstores love, or you can support your independent bookstore and buy it there.
Chris, great stuff. Appreciate it. Thanks for coming on.
Thank you for having me.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.